All right. Good afternoon. All right. Good afternoon, guys. It is June 23rd, 2022. It is just afternoon here in New York. Wanted to go over what's going on today. We're seeing a little bit of a rally that is getting faded. We started so strong today, and then now it appears as if there is some fresh demand to hedge. Okay, there's some fresh demand in hedging right now. We will see if this continues throughout the day. It's starting to turn negative. It was doing so well. Not so much anymore. Let's look at the other indices. Tech still very strong. There's a lot of bids in tech, especially some of the large cap tech names. They're catching a bid. I think it's just a little bit of bottom fishing that institutions are doing. Some of these beaten down tech names, Apple, Microsoft, these are the stocks that are up today. Amazon, Google. Well, Google is the most dollar sensitive of the major tech names. Okay, and the dollar is up today, so Google. The reason why Google is so sensitive to the dollar is because they generate a lot of their ad revenue from other countries as well too. So whenever they bring those dollars back into the United States, if the dollar is expensive, it actually cuts into their earnings. All right, so we're not seeing as much strength in Google, but as you can tell, for the mega caps, it is quite strong. Let's actually look at some of the sectors and see which sectors are the strongest here. Tech, obviously. Let's see if we're seeing anything else. So banks not as strong today. Energy's taking a hit. Let's see here. XLP, XLV, XLUs are all strong. Tech is strong. Retail also catching a bid. XBI. Let's see how small caps are doing. Small caps are not doing so well. And Bitcoin is up. One thing I noticed too in this market, especially in the past couple of weeks, is that the correlation between Bitcoin and NASDAQ is getting weaker. Okay. It was tracking it quite well. It was like a correlation like 0.8, 0.9 back in May and June. But now it's decoupling from the NASDAQ. We'll see what that means. I'm noticing that some of the other protocol coins, they're up. It's up pretty strong today. I'm not sure if that means anything. I don't know if that will spill over into Bitcoin and then maybe, I don't know, into other risk assets. By no means does that mean it's a bottom. I just think maybe there's a little bit of a short covering going on in risk assets. Maybe people were too short. We'll see. It's just an observation. We'll see if anything materializes. Let's go ahead and look at our data. Let's start with everything that we look at. Let's start with TNX. So right now, oops, what is that? Let's get rid of that. This is 10-year Treasury note yield. It is coming down. Okay, we are getting a little bit of interest rate stability, which is good. Well, it's good if you're long. So if interest rates are moving wildly, generally it's very difficult for institutions to value shares, and so you lose a lot of bids because of interest rate volatility. So stabilizing is a good thing. Let's see if so. Bond volatility came down yesterday. We'll see at the end of the day if bond volatility continues, coming down from its highs, or if it keeps going up. I mean, the trend in volatility right now for bonds seems to be that it's going up. Okay, it seems to be, but it may be breaking down here. We will see. This is the MOVE index. Again, this is the volatility of the bond market right here. Okay. Let's look at inflation expectations. TIP over TLT. Again, TIP is the inflation protected treasury ETF divided by TLT, which is the long-term bond ETF. As we can see today, it is continuing its way down. Okay, so maybe the market is pricing in peak inflation and a Fed funds rate topping out at 3.5 for the rest of this year. Okay, so that just tells us, what the expectation is for this season. I still think even if the inflation expectation does peak out here, and if the Fed stops raising rates at around, let's say, 3.5 to 4 Fed funds rate, I still think that if they ease that. That it may come, inflation and a more hawkish Fed, it may come back. We're already seeing that yesterday. In yesterday's video, I already explained that we've already been seeing some messaging from the Fed that maybe all this quantitative tightening that they have planned, maybe it's not necessary to do at all. Okay, and then yesterday we got even more of a hint of that. From one of the Fed governors, and I posted on Discord that, this is exactly what happened in the 70s. Okay. We would do a little bit of tightening, and then inflation would peak. People would say, well, now, instead of inflation fears, now we should be thinking about recession fears. We shouldn't stifle growth too much. And then the Fed would release pressure off the gas pedal on tightening, and then about a year or so later, inflation would come back. Okay, basically easing too early. All right, that's the risk here. Just like in the 70s, that's why it took so long for inflation to really get stomped out, and I'm seeing already kind of the repeating of that. I'm not saying that it's exactly the same, but history does tend to rhyme, and if that's the case, we could see a little mini bull market, maybe that lasts, let's say, 6 months to a year, and then it can continue the downtrend. We'll see. We'll take it one session at a time. But right now, that's what the bond market is telling us. That right now there is an expectation of peak inflation, and that maybe inflation, the acceleration of inflation, won't be as severe. We will see. We shall see what the expectations are. I mean, things can change very quickly in this market. I mean, we've been here before, and then inflation expectations have gone back up. So, we'll see. We'll see what happens. Okay. Let's take a look at some of the yield spreads. 10-year U.S. 10. Year yield, yes, minus U.S. 2-year. All right. This is important for bank stocks. Right here. So, for bank stocks, obviously banks want this to keep going up. All right. That way their profits. Their profit margins are better once the spread between the 10-year and the 2-year keep going up, we're seeing it pause a little bit back down. That's probably why bank stocks are not doing so hot today. This needs to keep going up in order for there to be some broader participation in the market. Okay, so that it's not just tech. If you want also banks to participate, this needs to keep going up. All right. So that's what I'm seeing in rates and bonds. Let's take a look at the dollar. Dollar is up today. It was lower, but it is rebounding. Let's take a look at commodities. Oil is down today because today, I believe, gasoline. Yes, gasoline was down. That crack spread is narrowing. Okay. Again, you could tell whatever story you want to tell yourself. Gas tax, vacation, whatever you want to, peak driving season, whatever it is. The stories and opinions, whatever, they can be wrong, but price and data is king. And gasoline price comes down, crack spread narrows, the economics of buying oil changes. Okay? We called the top around here. We called the top. We said if it comes back, we short. It doesn't look like Mr. Market is giving us that opportunity. It is what it is. I mean, when you manage risk properly, yeah, sometimes you don't get every trade. And that's okay. That's fine. Again, our job as traders, our number one job is preservation of capital and managing risk. Okay? There was no effective way of managing risk by blindly shorting this. We need that retest, okay? Because what if it was just a slight correction and it just kept going up, right? You want to be as close to where you get proven wrong. So if you were short around here, that 121, 122, and it closes above 122, 123, that's a very small loss that you're taking, and you know when you're wrong and you can get out, okay? Risk management is key. I don't know if gasoline is going to come back up to these levels. I doubt it. It would be such a gift, though, if it did and it brought crude with it. Oh, it would be such a gift to be able to short here. But, it is what it is. A lot of you can take XLE puts or XOM puts if your accounts are not futures enabled. But that's what I see here. Yesterday, I also went over to the grains. Grains are topping. I remember I said, I want a little bit better price before I get into my corn put spreads. Well, I should have just went in. I should have just been more aggressive about it. It's Murphy's Law, right? When you get aggressive quickly, the market likes to take its sweet time, but then when you're patient, the market just moves quickly, right? That's just like the story of my life for trading in 2022 right now. It's just, every time you're patient, market moves quickly, but when you move quickly, the market wants to be patient. So, it is what it is. I didn't really get my fill. But we did call the top in corn right here. Again, data. It's data. Everybody was saying, food shortages. They were looking at news. And this is why I tell people, shut the news off, okay? The news is not your friend. They're not there to really inform you. They're there to, it's infotainment, okay? So, yeah, food crisis sounds wonderful to click on, to read. It's clickbait, all right? That's not what the data said. The planters they were able to get their corn in the ground in time, okay? Fertilizer prices are coming down, all right? I said this yesterday. Corn, it's very nutritionally intensive, okay? It needs a lot of nutrients. That's why corn is very sugary and it's able to produce even biofuels. Okay, it's got a lot of energy in it. And but it's very taxing for the ground. All right, so usually after one or two corn plants, you have to put fertilizer into the soil. All right, and so that's why a lot of farmers they go from corn to soy. Soy is regenerative, so that's why I was saying a couple of weeks ago that if we see that planters did not plant corn and instead they went with soy because of the price of fertilizer, then we could definitely see corn prices go up, causing food inflation fears. It's not going to happen, okay? That's just not, the corn is planted. So outside now, does that mean that corn for sure is going to come down? No, there could be weather. The weather would have to cooperate too. Now, outside of any type of major weather disaster, I just don't see that happening. I mean, there is a lot of heat in the Midwest. Maybe the new corn plants, maybe they dry up, but I doubt that. I doubt it's going to stay that way. Chances are that the corn numbers, they're going to get revised higher for expected yield, and also too, again, fertilizers are cheaper. The yields will probably go up for corn. Okay, so I think this is kind of a seasonal top for the grains. Could it come back up in about a year or so? I think so. It could. But I think for this season, this is the top, and corn. Okay. So, yep, there's that. So I know a lot of you are really long into corn and stuff, but it's probably worthwhile to look into managing your risk. Okay, I know some of you are in options for some corn ETFs. Watch out, because some of these corn ETFs are like UVXY, or some of these like oil ETFs where they use futures. Okay, let's actually take a look here. I just want to take a look and see. Okay, so it's still in backwardation, but soon that backwardation is narrowing, and we could get into contango situation soon if corn keeps dropping. Okay, if you're in these futures rolling ETFs for commodities, and you're long and there's contango, you're gonna start facing decay. Okay, so keep that in mind. Right now it's in backwardation, but it drops any further and we wait 6 days, and this front month contract that expires in 6 days, that is where your biggest contango is. Once that expires and we're into the next months, the contango is much, much less. All right, and if it drops just a little bit further, I'm backwardation. The backwardation is a lot less, and if this drops any further, we could get into contango. All right, and those ETFs are going to start facing decay. So just a little bit warning there. Wheat coming down. What about soy? Soy also coming down. Look at that. All right. What about those feeder cattle? Feeder cattle still going up. There were reports of cows, dying, I think, from the heat. That's how hot it is. It's like 100 degrees, 110 degrees in some places in the Midwest. That's causing, I think, feeder cattle to still keep have a bid. Let's take a look. Oh, oops. Hog meat coming down. Okay, we'll see. We'll monitor that and see what's going on. But I think as far as food commodities are concerned, that's the top. One commodity, though, that I'm getting long on, and I've been adding to, I actually added a little bit. If you go to the Discord on our commodities channel, you can see I added a bit more of our gold spread, which is at the 180 to 200 call debit spread. So if we go to, I'm using the GLD ETF just because of the skew is a lot better. And I think for the delta, for the skew that I wanted, the skew difference I wanted, I could do it at a lower delta for December. But I added a little bit more of this. Again, it's still a very small position. I'm going to scale it very slowly on this one. Metals, when they turn, it's not like stocks where it could be a quick V. Commodities rarely do that. Generally, it's more of a cycle, and it's a more of a it's usually a longer move. It's never quick. So I'm willing to be a little bit patient here, but I'm scaling in more into this. Okay, the 180 to 200 call spread for December. Okay, I am scaling more into this. So I do believe that, I gave you that chart last time, but let me go ahead and recreate that chart. It is the, what is it? It's the gold over, gold over copper. Let me go ahead and try to do, I'm making that right now on TradingView. Just give me 1 second. Yep. There we go. Okay. Gold versus copper. It is rising. I do think that this is going to keep going up, which means we're going to see some demand for precious metals. And again, from yesterday, gold is not necessarily a hedge on inflation. It's not a very good hedge on inflation, actually. What gold is a hedge on is currency risk. All right, it's currency volatility. Okay, when currencies get volatile, gold looks like a better store of value. Okay. There are some industrial uses for gold, with semiconductors and things like that. But generally, most of it's used for a store of value or a hedge on volatile currencies. I still think that there's some volatility ahead in currency markets. We're already seeing, signs that other economies will have to tighten. Hong Kong is going to have to tighten soon. If you look at Japan, already Japan is facing some inflationary pressures. I think one risk that the market may be overlooking is, what if Japan, the lone dove in central banks, what if they start getting hawkish? Okay, as somebody in the United States with dollars, yes, gold may not look as appeasing, but I think if you are in Japan, I think it makes a lot of sense to, for a gold long trade. It makes a lot more sense for them. But we'll see, okay? I still think gold is going to go up before the end of the year. I think it's going to outperform the industrial metals. Definitely commodity markets are signaling a risk off. But these signals do take some time for the markets to notice, all right? Another commodity that I am bullish on right now is uranium. Okay, yes, you heard me right, uranium. All right, I really like it. Last night we were talking about uranium here at the Discord, and at first I did a little bit of research, just to see what was going on. At first, almost half jokingly, but after looking at some pricing from the 1970s, also from 2000s and also 2008, I'm starting to really like uranium. All right, uranium is coming out from its lows and it's revisiting some of its highs. Right now, it is around. Let's just take a look at just uranium on its own. Right now, this is the uranium to gold ratio. But if you just take a look at uranium, yeah, right now it's around 47. 47, 46. It was a little bit higher a couple months back at 62. It is coming back down. So maybe this is just a little bit of a pause. I think, especially with this conflict in Russia, I think there is probably going to be some demand for domestic production of uranium. All right. And already, I forgot from which bill or which package, but they've already passed something where where the United States government wants to commit, I think, $4 or $5 billion into buying uranium supplies, which is not that much. It's not that big of an amount, but the uranium market has kind of been at a low supply point. There's since 2004, and ever since the accidents in Fukushima, there's just been less and less production of uranium. All right, a lot of domestic producers haven't been securing contracts and haven't really been pushing a lot of uranium out there, and so supply is down, and most production is down as well too. And if you look at some of the earnings of some of the major uranium players here in the United States and in Canada, a lot of them are waiting. A lot of them are just waiting for prices to go back up before they ramp up production. So I see that if uranium demand starts picking back up, and usually it does when oil prices are this high, if there's a demand pickup, I can see there being a supply shock in uranium. Okay. And especially if the United States ends up, getting a little bit more serious, and the rest of the world starts getting a little bit more serious about nuclear power, I can definitely see this going up to perhaps its old highs, in the hundreds range. That would be good for certain uranium players. It is high risk, though. I will say whatever you do with uranium, it's going to be high risk. You're taking on a lot of political risk on this. It's not really looked favorably upon politically in some parts of the world, like in Europe, for example. Outside of France, but in France they use a lot of nuclear power. But if a lot of governments say no, and there's a big movement away from uranium, then obviously it's going to come down. I don't see that happening. I actually think it's a good chance that we might see a supply shock and uranium. All right. So how would you be able to play this? The uranium futures it's so thinly traded, and probably not a good option for you guys. There are certain uranium ETFs that you could play options on. I'm actually thinking about buying shares in a uranium miner, and there's some different miners out there. The biggest one is CCJ. That seems to be the one where a lot of uranium ETFs like to use CCJ as their main holding, as their biggest holding. It is looked upon as the more stable of the uranium miners. I didn't do that much research into CCJ. Again, I just started researching this last night. Okay, so I'm not an expert in uranium or anything like that, but that's just the research that I've found just in the last, I would say, 14 hours, just doing some market research. And not necessarily on the stocks, but just on the structure of the market. But it looks like uranium, it just hasn't been widely produced. A lot of the producers have been holding back and scaling back for the past 10 years. And so usually when you see that, there's a very good chance that there's a supply shock. And that was the case back in the 70s too. There was a supply shock in the 70s. Same thing with the 2000. There was a supply shock. It seems to be that this market goes through these cycles of no production to supply shocks, and then back to limited economic activity. So it keeps going back and forth between those two cycles. It seems like that's the pattern for this industry. So we'll see. I know I looked into some of the earnings of some of the major miners. They're still cash flow. Their cash flow is still not positive from their operations yet. It does appear as if they do need some sustained prices in order to really ramp up production and be committed to that. A lot of these producers are also looking for longer term commitments from their clients. Their clients being, nuclear plants, utilities, governments, institutions like that. So they do want to see that longer term commitments, and a lot of them have been looking for those longer term commitments from their clients about 1 to 2 quarters ago, or mostly about a quarter ago. Okay, they're starting to look for that. So already the industry, I think, is looking at the possibility of a ramp up in demand for uranium. It seems like, okay, but it also seems like, a lot of the uranium ETFs like URA, they're using CCJ as their main uranium miner, their top holding. I am actually looking at Denison Mines, which is a Canadian mine. Oh wow, it's at 98. It's under $1. I was gonna say if it goes under $1, I might buy. It's already there. Yes. So this is, I would say, so uranium again, super speculative. Okay, just anything in uranium is gonna be speculative. All right, it carries with it a lot of political risk, a lot of legal framework risk. So even if we do get the quote unquote market conditions we're looking for, if governments say, no, we're going to scrap that, well, there goes that idea. Okay. So I wouldn't do anything too crazy with this. No zero DTEs, guys. Come on. Let's be real. Don't do zero DTEs. I don't even think there are zero DTEs on these, but if there are, don't do it. If there are, I'm sure one of you will sniff it out. But I think for something like this, I think buying shares would be better, and keeping your position small. If some of these names go up, I mean, they're going to go up a lot. Okay, there's no need to be greedy and put a significant amount into this, or or anything like that, or play options on really, really high implied volatilities. I know some of you, like to take a $1 stock. This is a $1 stock. Actually, it's less than $1 now. But some of you like to take a $1 stock and like to buy 20-cent options on it. There's no need for that, man. It's already $1 a share. 100 shares is $100. Okay, 1,000 shares is $1,000. There's no need for you to do these high IV options on a cheap stock like this. Okay, I like Denison. The reason why I like Denison is because it has no debt. They have been watering down their shares. They do issue. They've been issuing shares for the past few years, and that's why they have so little debt. But in this age of credit tightening and interest rates rising, I kind of like the fact that they don't have any debt, and maybe they stop issuing shares. They do have a decent amount of cash in their books, enough to ramp up production and maintain their mines for the next 12 months. So I think that's a good sign. By the way, I had a comparison line. I guess it went away. Yep, let's do that. Give me 1 second. Regular. Let me try to pin to a new scale on the left, and no percentages. Regular. Yeah, I just wanted to show you And let's change the color so that it kind of pops out more. Okay, there we go. So yeah, so as you can see, it tracks very closely to the price of uranium. Okay, very closely to the price of uranium. All right, I think their earnings is coming out in August. The people that follow this industry, they're looking for the next 2 quarters to see some positive cash flow from operations. That would be, that's what a lot of these analysts are looking for. Not that I follow analysts, but it's what I think it's important to know what other people are looking for, though. But it does track it very closely. Okay. Same thing with CCJ. I mean, it all tracks very closely to the price of, I looked at some other uranium stocks too. There's a lot of uranium. There's actually a good, not a lot, but a good number, and they all track it very well. These are the top names, by the way, that I noticed in on a lot of uranium ETFs. So URG, UEC, UUUU, CCJ, and DNN. Those are the names that I keep seeing in uranium ETFs. Okay, I just like DNN just because it has low debt. Also, too, the IV is quite high. It's a very high IV stock, 112%. So very good premium generation. If I buy into it, you can definitely bet that I will be aggressive in selling covered calls in this. If I buy if I get into DNN, I am definitely going to try and make them free by 2 or 3 quarters. I'm going to aggressively sell covered calls on them and try to reduce my cost basis and try to get them for free. Okay, over time. Okay, because it is a very high risk. I want to reduce as much of this risk while I hold it as possible. Okay, because what if it collapses, right? So I'm going to be aggressively selling covered calls. If it pops and it goes over my covered call strike, it is what it is. It just locks in my profit. I'll be selling covered calls above my cost basis. Again, let me say that again. I will be selling covered calls above my cost basis if I buy into this, and I will be aggressive in doing so. If price were to come down, I will be rolling those covered calls and making sure that I take as much premium with me as possible. Okay, when risk is this high on the underlying, you got to make up that risk somehow, and the best way, in my view, of managing some of this risk is making cash income. Okay, make that cash income. So selling covered calls, getting aggressive on them. Right now, some of the August, September. Actually, we don't need to even base it off of memory. Let's just go into the option chain itself. I mean, the option chain, there's no weeklies, but even 2 weeks out, the $1 strike is 13 to 15. So you're looking at 13 to 15% for 2 months, which is pretty good. The implied volatility dropped today for 82. Huh. It was at 100 yesterday. Maybe that was just for the end of the day. Huh. Wow. UUU actually has a higher one. Huh. I might have to reconsider which one I use. So yeah. So okay. Again. This is a new idea right now for me. I just started researching this yesterday. Oh wow, UEC. That's some decent premiums. That is some decent premiums. Wow. Okay. So maybe DNN is not the highest of the IVs. I thought it would be, but it's not. Okay. What else? CCJ. Let me see what CCJ's is. It's a 68. So okay, so UEC, maybe it's UEC. I would have to. I need to do more research then on the company and see how much debt they have. I don't want to be in a company that has a lot of debt right now, especially with interest rates rising. Just don't want to do that. So I'll have to do a little bit more research. Okay, and I'll get back to you guys about this. But I'm starting to get bullish on uranium. Okay, uranium and gold. Those are the two commodities that I'm willing to be bullish on, and silver as well. Precious metals and uranium. I think a lot of money from oil, a lot of money from perhaps equities. I think will make its way to gold and precious metals. Okay, so I think and also too, when commodities boom, not all of them boom and bust in the same cycle. Okay, some grains, meats, precious metals, industrial metal, even amongst the metals, not all metals move the same. Industrial metals will move a little bit differently than precious metals. So we're so used to this idea, as especially for those of you that are more into stocks, that when stocks go up, all stocks go up, and all stocks come down, in these big macro trends. But when it comes to commodities, they don't all move the same. Okay, sometimes one group of commodities will do better, and as they fall, another group will do better. I think right now, precious metals are going to have their time, especially if the dollar comes back down. All right, and so I do have a lot of trades. Or some positions, not a lot. I'm still mostly in cash, but we have the short FXI, we got the short EEM position that I'm still in. Just so that you guys know. Oh, by the way, when it comes to FXI, I opened another position too. By the way, I just opened up the November put spreads. I added to, I guess, my August. The August ones, I'm still holding on to them. We're a little bit at a loss on these. I mean, not that much, but I'll hold on to it. I still got almost 2 months into it. But I scaled in more with the November 31-26 spreads. I have more than I've got almost a 4-to-1 reward to risk ratio on these, and we've got time. So all the strategies that I'm doing right now, especially for this market, is for people that don't want to be in front of their screens all the time. Okay, by no means, somebody asked me yesterday, I just don't have the time to be as active as you, and punch all these buttons. I don't do that. You don't see me day trading. I don't like to day trade myself. I operate a business as well. As a main, my main source of income is another business that I'm in, and sometimes, I have appointments that I have to do. So I'm not sitting around my terminal all the time. And I know most of you out there is probably the same. You guys are working. You probably can't be day trading 0 DTEs all the time. I agree. And in this market, you don't want to be in anything short dated. Okay. So, the big money in this market is in multi-week, monthly moves. Okay. I've said this before, and I'll say it again. And you can look through my personal Twitter post. Before I formed this Discord, my biggest win this year was building those put walls 3 to 6 months out here. Okay, I was really able to lean into that, and I sold those puts right here. That was like double to triple. Okay, that took what? 4 weeks. I didn't push any buttons for 4 weeks, but I still made a lot of money. All right. I set a limit order, and I just waited. And once my limit order hit, it automatically sold my spreads. I didn't even have to be there to sell it off. I just set my levels, and it just automatically, the market just took care of it. All right. That's the type of trades I like. I like these long, weekly big trends that are high probability of success trades that pay out. Okay. Yeah. 0 DTEs, you can make 500, 600% or even more, but those are really high risk. They have a very good chance of going to zero. You can't put more than one 2% of your portfolio into something like that. So, okay, you put 1% of your, or let's say 0.5%, 1%, let's say up to 2% of your portfolio in something that goes up by 500%. I mean, yeah, okay, fine. You just made 10% of your overall portfolio, right? 2% times 5, it becomes 10% of your portfolio, but these kind of trades you could lean a little bit more into. You could lean up to like 10, 20%. For me, because this is my spec account that my spec account is all from selling premium on my core portfolio. My core portfolio mostly is in SPY. I do have some Apple and Chevron stocks as well too. But the dividends and the premium I generate for them all go into my spec account. And my spec account I use for these speculative plays, these swing plays, as well as to hedge my overall portfolio. So when I built those put walls, I put about, for me, and everybody's risk management is different. You don't have to do what I do, but I put about 50% of my spec account into that. Okay. So you're able to do stuff like that. Would I recommend doing that? No. I mean, again, for me, that money, my spec account money, is just premiums that I generated from my core account. So, and also because it acts as a hedge, that position acted like a hedge, that made a lot more sense. But for you guys, that might not make sense. But 10, 20% into a trade like that, into the longer term trend, you're going with the longer term trend. You're looking at high value places. We talk about high value places to buy, but there's also high value places to short. That was a high value place based on the data. The data was going our way, and it's going with the overall trend. And, we're with spreads, which is already a hedged bet to begin with. So it's almost like it's a hedge on my overall portfolio, plus it's already hedged. So that's why I was able to take that and lean really into that as a percentage of my portfolio. So for you guys who are not hedging, or maybe don't have a portfolio to hedge in that fashion, you're still putting about 10% or so of your portfolio into that. If you double or triple that, that's 30% of your portfolio you're gaining. Whereas, 500, 600% on 1%. I mean that's all right, but really the big money is made on these big weekly, monthly moves. Okay. The next one that I'm planning is this oil. Again, if I don't know if it's going to happen, but if it can get to here, oh my goodness, I will definitely lean into that trade. Maybe not 50%. I'll probably do like 5 or 10%. Of the spec account, up to 10%. I would short right here, 121, 122, boom, put spreads right here. Long on put spreads, boom. That will pay out if it goes down. But I mean, it's got to come back here first. I don't want to short here. I mean, could it go down more? I mean, it could. I don't see it coming down further from here. Actually, I see it probably going between this 100 to 120, maybe even down to maybe 90 at the most. But 90 to 120 is probably going to stay here until later on this year. If we are lucky enough to get here, definitely that's a high value trade right here, shorting this. I will wait. I will be patient. We talked about fertilizer prices coming down. Natural gas is still continuing its downtrend. In Europe, it's not, though. In Europe, it's going up. Okay, if you take a look at natural gas prices in Europe, they are going up. That export terminal, all that supply now is domestic supply. That was earmarked for Europe, but now it's domestic. So it definitely putting some price pressure on fertilizers. That's why corn, I think, is on its way down. Okay? I think it's on its way down. We'll see, though. We'll see what happens. We shall see. Again, gold. I'm long on gold. I'm long on uranium. On my portfolio, no. I haven't gotten long on uranium yet, but I am looking at some plays to get long on uranium. I want a uranium miner that I can buy shares in and that has a high IV that's got low debt. That's what I'm looking for. So give me another day or two to find that. I thought it was going to be DNN, but its IV is lower than what I thought. So I want a uranium miner that's got very low debt, that's got a high IV. So if you guys have any suggestions, if you guys do your own research on stocks and you got a uranium play in mind, hey, let me know. I'm always looking for that. I'm always looking for some good plays, and I think uranium is the way to go. Those are the two commodities I'm bullish on. What else? Let's take a look at some of our other positions. So that's FXI. I'll open up a new FXI position. Oh, it looks like we're in the profit already, so that's good. Scaled in a little bit more on my GLD, like I said. I already showed you guys that, but I'll show you again just in case. December's, the 180 to 200 call spread. I'm still in my UVXY call spreads for December 15 to 20. These are still up about 20%. They were up like 50-60% like a week or two ago. But I think if we do have some volatility, it could really cascade. I mean, look at where VIX is. VIX is in the 30s. I can see, if we have renewed inflation risk, especially if the inflation numbers keep coming hot. If the next 2 or 3, if it still keeps going up, I can definitely see VIX getting to 40, and maybe UVXY getting into the 30s. That would be like almost full profit then. That would be nice. I got in at like around the 80 cents for a $5 wide spread. So, I mean, that could potentially be a 400-500% payout. That would be nice. That would be really nice. Too bad I didn't get more. Yeah, I mean, in the past couple of months, it has paid to be aggressive going short the market and long volatility. Short equities. It has paid to be aggressive in that, but we'll see. EEM. I'm still in my March. I try to scale in some more, but it's really hard to get a fill. I might just hit the ask. I don't know. It's coming down already. It was up today. Should have hit the ask earlier, but it didn't. So we'll see. Maybe it pops up a little bit more. I've got time on these. I've got time to scale in if it pops up. But I still think that there's going to be some an emerging market debt crisis. Even if inflation expectations here domestically here in the United States, even if they get better, I still think the dollar having gone up so much, it's going to cause some issues. Oops, that's not the chart, but I think it's going to cause some issues. We're already seeing issues already. I already told you about Sri Lanka, but I think other countries are going to follow suit pretty soon. Latin American countries, Southeast Asian countries, Italy, possibly Italy, Greece, those countries that we typically deem as emerging markets, I think are going to start getting hit. Even non-emerging market, like places like Hong Kong, they're going to have to tighten at least. And so that might slow them down. And I know Hong Kong, China, they're very much well represented in the EEM ETF. All right. Oh, what a gift it would be if this thing comes down to like 30. What a payday. I don't have that many puts though. Again, I'm mostly in cash still. I'm trying to leg in. It's not giving me very good opportunities. I thought at least it would maybe hit this line here, but it's not. It's not. I scaled in I think last week or the middle of the week before, something like that. But it hasn't hit that after I started scaling in. It hasn't hit this yet. I just wanted to hit that so that so I can get in for cheaper, but we'll see. Okay, we gotta take what the market gives us. SPY valuation lines still looking to leg in, starting from this line here, 342. I'll be legging into some shares, adding to my overall long-term portfolios at 342, scaling down, getting bigger and bigger as we go down. Under 300, I'm buying like crazy. All right. If we get there, I'm not again, I always say the same thing. I'm not trying to predict the future. I am just anticipating what could be. Okay? So again, UVXY longs, gold long. I want to get long on uranium. FXI short, EEM short. And that's good. Also, it's a good way to also, counteract dollar risk. I have some plays that will do well if the dollar goes up. I got some plays that will do well when the dollar comes down. Okay, so a little bit of putting a little bit of a negative correlation there, so that not everything is just correlated to the same thing. We will see if it gets there or not. We'll see. But I would like to get long over on here. And right here around this zone, I may even get into some like 6-9 month in the money calls just to get a little extra juice, on the bounce. We'll see. We'll see. Any questions you guys have? Any questions? Anything? You guys can take yourselves off of mute if you guys want to. Your voices will not be on the stream. We are streaming live right now on Twitch and on YouTube, but I muted the desktop volume. So even if you guys speak right now, it will not be on the stream. So if you guys want to ask me questions, or if you guys feel more comfortable putting your questions in the voice chat text. What about wheat? What about wheat? Oh, that's a good. I didn't go over wheat. I thought I did, but okay. Maybe I missed it. Wheat's coming down. I think maybe the risk premium from the war is coming down. I mean, the two best commodities after Russia invaded Ukraine was wheat and oil. Those were what had the strongest reactions to that. Perhaps we're seeing that come down, that risk premium. There we go. So there we go. Risk premium is coming down. It was over. It was a little bit over, like overreaction though. I mean, let's be real. Like this, if we flattened out this and made it into a line instead of a bar, that's a parabola. Okay. I'm sure some grains are making its way out. Okay, and I think cooler heads are finally settling down, or cooler heads are prevailing, and especially with corn. Corn was one of those things where people were just getting crazy long on corn, all on hunches. Okay, and that's why I kept saying we have to wait for the data. We have to wait to see if they're planting corn or not. People are, were already screaming about shortages before the planting numbers were even out, and now a lot of them are going to get caught holding the bag. I think numbers are going to get revised. Watch in August, September, minus any really bad weather. And again, that heat, a lot of corn planters were holding off on planting corn. Again, not just because of the fertilizer price, but because of the weather. We've been having some nasty weather here in the United States. Lots of heat, and then tornadoes. So it's just been kind of wild, and I get it. Like as a farmer, my heart goes out to you. It's been a hard season, and so will those corn plants survive? I mean, I think those kinds of natural disasters. Yeah, maybe they're coming up a little bit more frequently, but I just don't see it. I don't think it's going to hurt supplies that much. I think the expectation is that supplies are going to be so low. I just don't think those expectations are going to play out. I think they're going to revise corn numbers up. Okay, I think so. I think yields are going to go up, and also too, fertilizer prices are coming down. They can fertilize the ground. They don't have to rotate into soy just yet. Although, again, feeder cattle seems to be keeping its pricing. Again, I saw that report over the weekend about those cows dying from the heat. July 4th may be a little expensive. The barbecue might be a little expensive. We'll see. Any other questions? Anything else you guys want to look at? Oh, Bitcoin. Did I look at Bitcoin yet? No, I did not. Let's look at Bitcoin. What's going on? Bitcoin. Yeah, I mean, the options data really hasn't changed. I saw somebody posted something on Twitter about all these options, huge amount of options expiring this Friday. I mean, we saw it coming. Okay, we saw this coming here at Checkmate Trading, right? We talked about this for weeks now, that hedging demand is getting greater and greater in Bitcoin. I think, I guess people are just realizing this. But we've been on top of this for a while now. Okay, so we saw that heavy demand for hedging on 20,000 or lower for this week. If we look at the quarterlies and monthlies going out, we're seeing some demand on the 15,000s and lower. So definitely there is some demand, especially out till the rest of the year for 15,000 and lower, and down even into the 10,000s. So. Those were some huge volume trades. So I'm guessing, my thesis is that there's some institutions out there that are afraid that we might be seeing a little bit of a shakeup in cryptos. And I think crypto right now is having their 2007, 2008 moment where all the risks are intertwined. We're seeing certain key firms falling, and it's causing liquidity crunches on other companies and protocols that are linked to it. All right, much like in 2007, 2008, it was real estate, then the mortgages. The mortgages were packaged into securities, and then those mortgage-backed securities had credit default swaps attached to them and insurance on them, and one company was insuring the default risk of another based on this security, but all those securities were all tied to the real estate market. All these risks are intertwined, right? And I think right now we're seeing that with in the crypto space. We're seeing the weaker ones getting knocked off, the more leveraged ones getting knocked off. But the cockroach theory. When there's one cockroach, there's a lot. So I think we're just scratching the surface on this. Right now, it's like those savings and loans are failing, but I don't think we've had the Lehman moment yet, where we see a major player really fall. I think that's about to happen soon. As we get tighter and tighter, liquidity gets tighter and tighter, credit gets tighter and tighter, we will see the biggest cockroaches come out. Okay. I think we will have that moment where it really does capitulate, and that's when I think we'll see those lower prices, 15, 10. I know some of you are expecting a little bit lower. We shall see. We'll see. We'll take it one session at a time. Say that again. A Sailor, Sailor said something at the top. What did he say? Or was it cliche really super bullish on Bitcoin? Was it super bullish? And he said it at the top of the day, huh? Yeah. Yeah, and you know what? It's a funny thing about Michael Saylor too is he should know better than to go full port. He ran into this problem in the .com bubble. He made his initial fortune. Yeah, he made his initial, I guess, name for himself back in the .com era in the 90s. He got burned in going full port on his tech companies, and now he's full port on Bitcoin. I mean, come on, man. And he's a smart guy. He's an MIT grad, and I just don't get it why he just goes full port like that. He should have learned his lesson. Then again, it's the curse of the Midas touch, right? You think once you have a success, you think everything you touch is going to be success. Look at Elon Musk, same thing. He should have known better. He should have known better than to put his shares up for collateral to buy Twitter. His colleagues he lost control of companies that way in the 90s. He's also a product of that .com era as well too. So it seems as if it's a common theme in humanity where people don't learn from the past. It's almost like our Federal Reserve in the 70s. I mean, they're already talking about taking their foot off the gas pedal, and it's like, this is exactly what happened in the 70s, guys. Like, and you know, they even talk about Volcker, but it's like, you're talking about it, but you're not really seeing it. You know, I just don't. You know, humans are just funny. It's just funny creatures, in my opinion. But yes, history doesn't necessarily repeat itself, but it does often rhyme, and we are seeing multiple examples of that, I think, in today's market. Yes. Anything else you guys want to see? Anything else you guys want to take a look at? Any thoughts? Anything you guys are looking to trade? I know I talk about my themes, but you know, if you have themes, investment themes of your own that you want to discuss, go ahead. Yeah, IWM. I mean, again, I'm trying to do the same thing you're doing. I'm trying to build put walls myself, but man, dude, it's not giving me a good opportunity, man. It's just I really wanted to see SPY at like 390, 400 before I do that. Okay, just because the IV will have, you know, gone down. Right now, it's elevated IV in IWM. I mean, let's just take a look, see what's going on. We don't have to guess. I mean, yeah, current IV percentile at 65%. I mean, that's, even if I do a spread, I mean, that's still, I'd like to see a little bit lower. I'd like to see that a little bit lower. And the only way I'm going to get that IV to be lower, or that IV percentile to be lower, is if we have a little bit of a rally to short into. You said it's a month out. Your puts are a month out. So that's what you're looking at: July expiration or August expiration? Late July. Late July. So late July. I mean, let's just assume it's the OpEx, the monthly OpEx. I mean, hopefully it's closer to at the money. I'm not sure if we're going to be seeing that kind of a big shakeout. I mean, obviously, if VIX goes up and we have another risk off moment, it could definitely pay out. But oh, you got a spread? You got a spread, or is it you're long on both strikes? Okay. Right. I mean, it's right now we're kind of in no man's land, and right now there's no edge. There's really no edge in putting a trade on an index right now. Well, at least a U.S. based index. I to really get an edge, I want to see certain value points. I want to go back to where hedging demand is strong, and hedging demand seems to be strong when we get to 3,900. I mean, that's just based on what happened 2 weeks prior. We just saw huge hedging demand right here on 3,900 to 4,000. I suspect that if we get there, we'll probably see that hedging demand come back. And I would just like to see that before entering, okay? Is it possible I'm just going to miss out on the whole train? Probably. But, you know, I think risk management is key here. If I go long, I'm not using IWM to go long on any index. When I go long on an index, I usually go long the SPY or SPX only. Maybe QQQ. Maybe QQQ every once in a while I'll go long on that one. But I generally do not go long long term on IWM or something like that. I use SPY or QQQ for that. But short, oh yeah, I would love to short IWM. It's the most liquidity and credit sensitive index. I was hoping 190. Oh my god, 190 would be such a gift. If we got back to 190, I'd be building those 160, 150 credit spreads at that point, 6 months out, and just waiting for a drop. But right now, you know, conditions are improving. I'm not saying they're bullish. I'm not gonna say that. Okay, I'm not gonna say bullish, but credit conditions are improving. Okay, for example, again, let's just go through the data one more time. TIP over TLT, it is falling. Inflation expectations are falling so far. Okay, now could it bounce back? Yes, it did right here. So if this keeps falling down like this, I think then seasonally that we might see a little bit of relief rally. That relief rally may last a while. That doesn't mean the bear market is over. Okay, again, in the 70s, I keep saying this, you know, we had a longer term bear market, but in between we had bull market years. We had like a year and a half, a year or so where we had a bull market in between bear market years. Okay, so it is possible that we have a relief rally that lasts until like mid to end of next year. Very possible. That doesn't mean the bear market, the multi-year bear market is over though. That doesn't mean that. Okay, you have to keep an open mind about this. All right, so we may rally. It's definitely in the realm of possibilities for us to rally for the next 9 months and then come back down to hit the lows again. It's very, very possible. I think it's going to happen actually. No, I think the path of least resistance at this point, I don't want to bet right now, but if I were a gambling man and if I needed to place a bet right now, if there was a gun to my head and they said you have to make a bet right now, I would bet that we rally and then we make new lows probably around 2024 or maybe later 2023. That's what I bet on, but we'll see. I mean, I again, I don't have money on that. It's just an idea, but I mean, look at the data. I mean, the TIP, TLT, the expectations are for peak inflation. Corn's coming down, oil's coming down, dollar's pausing its uptrend. What else? TNX. Let's go to TNX. TNX also, you know, 10 years coming down. It looks like it's on the left. Prices are on the left. This is probably from the previous chart, but no, look at the prices on the left. So TNX is at what, 3 right now. So, you know, I think the expectation is that you know that this is going to be the high end yields. I want to see a yield spiking to be really confident on any type of put position, long put position or short equity position. I would want this to keep going up. Also, too, you know, I showed you guys the 10-year, the U.S. 10-year minus the U.S. 2 0.2. I think TradingView is 0.2, right? Yeah, 0.2. Okay, yeah, this, I also want this to go up because without this going up, financial companies, banks are not going to be able to participate in the rally. Banks need this to go up. Okay? Banks really want this to go up. All right? That way their loan spreads get better. Without this, they're not going to be loaning money as much. They're going to be tighter with their money. Okay? You want this to go up. All right? Just curious. I want to see what the 30 and 10 spread is. So that's increasing. That's good. Oh, that's good for equities. Not enough, though, to be convincing. I'd want to see that go up a little bit more, like in the 0.4s, 0.5s. What else? You know, HYG, junk bonds. This is the very kind of a risk on sentiment. If people are willing to take a risk for yield, this is a good indicator of that. This is the junk bond ETF, high yield ETF, but it's junk bonds. It's stabilizing, but I would want it to see. I would want to see continued upward prices on HYG. I do think that if HYG or if corporate junk credit goes up too fast, the Fed may try to talk it down, because right now what the Fed is trying to do is increase productivity. And one way to increase productivity is to destroy these zombie companies that are not producing. Okay, there's a lot of small cap companies, there's zombie companies in the Russell that don't make money. They don't make money. They don't really do much economic activity, and they've been surviving on credit. All right, those need to go away for productivity to increase. So if those companies can access credit cheaper, i.e. HYG goes up, then it goes against everything that the Fed is trying to do. So I can see them trying to talk this down if it gets there. I don't know. I don't know if it will get there or not. But if it does, if this starts going up, you can definitely say that that's going to be a risk-on sentiment. But then at some point, I think maybe here or so, the Fed will want to talk it down. So we'll probably see this period of chop. Even if there is a recovery and a bull market year, I don't think it's going to be straight lining up. I think it's going to be people are going to be unsure about it the whole time. And then just like in the 70s, when they think the bear market is over, with 6 months of chopping upward, they're going to say, okay, finally the bear market is over. Boom, that's when it continues probably. That's kind of the narrative how it was in the 70s. People thought it was over, and then it came back, and it lasted, 8-9 years, 7 to 9 years, something like that. I don't think it's going to take that long here, because the world is a lot more connected place than it used to be. Funds travel a lot faster between borders, so the markets move a lot faster. Even if I keep saying lost decade, I think the lost decade will only be maybe 5 years or so for us, but nonetheless, it will be it will be a wild ride, and most people are probably not ready for that yet. I think people are just getting ready to accept the fact that a recession is likely. Okay, we've seen this. We knew that that the possibility of recession was real. We saw this months ago. I think Toasty and we've been talking about that since November of 2021. Now people are calling it the R word, and now people are saying it. I think people are a little bit behind the curve, but it's not what our expectation is. It's not about our opinions. It's about the market's opinion. We have to follow the market in the end. Any other questions? Mitch, what kind of TV you watching, man? Sounds exciting. Okay. Any other questions? Questions, comments, rude remarks? Yeah, we looked at oil. Yeah. If you want, we can look at it again. We can look at it again. In this market, I say take your profits. This market is so much chop. I always tell people this. When you judge a position, always ask yourself this: if I were to lose the profit that I've made in this position, would that hurt me more, or would it hurt me more that I missed out on more profits if I take profits too soon? Ask yourself that question. What hurts more, giving up the profits I made, or losing out on more profits I could have made by staying? All right. And that should tell you whether or not you want to cut or not. So right now, your gains, if you lost it, would you be okay with it for the chance of more? And if that answers a no, then yeah, take your profits, Yeah. Yeah. What are you using to do that? Are you using XLE, USO? What are you using? Oh, drip? Direction. Oh, Direction. Oh my god. Okay, well, Direction. Direction. I don't know. Direction has like a reputation for their funds just blowing up and being discontinued. Okay, well, as long as you make money, as long very good. I mean, then yeah, I mean, there's nothing wrong. There's nothing wrong with taking some profit. The biggest fool is a person who sees their profits turn to losses. Okay, that's the biggest fool. Okay, so there's nothing wrong with taking profits. You're never gonna get in at the exact bottom, and you're never gonna get out at the exact top. Okay, so take that fantasy and just like take it out of your mind. Okay, you're never gonna get the top. Okay, so take your profits in this market. And what I just said, about the mindset, would it hurt more if this or that? It also works with losing positions too. If you're at a loss in a position, ask yourself this: if I were in 100% cash, would I buy into this position right now, or would I not? Okay, so if you have a losing position, just say just imagine you're in 100% cash and say, okay, if I were in 100% cash, would I be in that position? Would I get into this position right now, or would I be out? And if you say to yourself, if I were 100% cash, I would not be in this position, then you probably should cut your losses. Okay, so that's a good kind of psychological test for yourself. Okay. Well, now watch it moon. No, I'm just kidding. 21, okay. And you're out at 25. Tomorrow it's going to be a 30. Look at it. Not just kidding. I'm just kidding. Oh, wow. Profit taking, yeah. I think a lot of people, if you especially if you're newer in trading, if you walk away from 2022 with even like 1% profit, I would consider that a victory if you're new. Especially if you have a smaller portfolio, because smaller portfolios you can't really sell a lot of premium. For premium sellers, though, this has been a dream market. But for some of you guys who have smaller accounts that are newer, if you guys don't lose in 2022, I would consider that a victory. It's a very tough market. It's not an easy market. Even a lot of professionals are getting caught off guard. So don't feel bad if your rate of return is low. Okay. I would feel bad if your losses are great, though. I mean, you never want losses. Okay. So, but just I think right now, instead of really hitting home runs, you really should be thinking about protecting your capital and protecting profits that you're making. Okay. I think that's the key for 2022. Protection. Okay. Protect your capital, protect your profits. Okay. Keep your position small, manage risk. If you take one takeaway from all these videos, okay, I don't care about I don't care if you learn about the triggers or the data or the options positioning. All that advanced stuff is great and all, but I think first, second, and third most important things is risk management, protection of capital, protection of profits. Those are the things you really need to concentrate on. I don't care how smart you are, how good your data is. If those three things, if you're not good at risk management or protecting your profits or protecting your capital, that stuff is meaningless. Okay, all that advanced stuff is meaningless. But yeah, I commend you on managing risk and taking your profits. That's a good thing. That's a good mindset. It's a winning mindset. You always want to end with a win, and that's how winners do it. Okay, so very good, very good. Anything else you guys want to look at? Australian dollar breaking down that FXI position. I think so. Yeah, I keep telling you guys this. Wherever Australian dollar and copper goes, China follows. Okay, let's just take a look at that position. Oops. Right, AUD USD continuing its fall. I'm calling BS on that FXI rally. I'm calling BS. Because Australian dollar is coming down, and also supposed Dr. Copper, which is not a good. Look at the copper breaking down 6%. Look at that. Whoa, look at that. I cannot. Oh my God! Please, 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 China. The thing about China, though, that makes it so difficult is that all the news that comes out of it and all the surprises that comes out because of the Communist Party, they make announcements about they're gonna do whatever it takes to bolster the economy. They always make these like crazy like announcements, and it makes the market whiplash and this and that. But that's what makes China investing in China very difficult, or trading China very difficult. They don't do like advanced signaling like the Fed does. The Fed does a very good job of signaling way in advance. China, not so much. And also they love to just surprise and like pump liquidity into the markets like over a weekend or something like that. That's what we saw on Monday. We just or on Tuesday when we came back, we just saw them they had pumped just huge amounts of liquidity into the markets. But I don't think that's enough. I don't think that's sustainable. Okay, and I think currency traders are saying, yeah, that is not sustainable. I think they're agreeing with me. They're probably looking at the same data I'm looking at. And also, too, copper, can't get rid of it fast enough. All right. Oh yeah, I told you, man. I told you. I mean, everybody was so long, like unnecessarily long on commodities, like without data. I mean, it was all based on speculation. I mean, hey, Jesse Livermore said it the best. Speculation is as old as the hills, but opinions can be wrong, and markets can be wrong longer than you and I can be solvent. Okay, I'm not saying the market is wrong here, but I think it was a little bit of an overestimation, over-exaggeration in price rising, especially in corn and food commodities. People thought it was the end of the world, that we're going to have like mass hunger. I mean, it's still possible. It may happen like in a year or two. Yeah. 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 No, well, I think it's not gonna be like systemic as like 2007, 2008 was. I don't think you're gonna see like financial institutions fail or things like that. I don't think Yeah, You're probably not gonna see as massive unemployment as that, but definitely we might see like prolonged stifled growth, though. That's definitely a possibility. It just causes a lot of anxiety when it's so drawn out like this. In 2007, 2008 was like 16 months of pressure. 2020 was very quick. Most people are not ready to see stifled growth or low growth for like 5-10 year periods. That's when anxiety really starts building up, especially amongst investors. It makes it a very challenging decade. But a lot of people were going along on corn thinking that corn supplies were going to go down. I mean, maybe it's a little bit of a dip, but it's not at the scale of what a lot of speculators were thinking. And again, I think those corn numbers are going to revise up. And then all of a sudden, people are going to be like, oh, what happened to that world famine? Well, the things like that are not very common. There's a reason for that. But yeah, that's what the market is telling us. I don't care what the media says, but the market is telling us this. The data from is all telling us that the corn is in the ground. Okay, it's in the ground. All right, so if it produces crop, if most of that produces crop, we're gonna be fine. So we shall see. We will see. We'll see what happens. Let's just take a look at TNX just one more time. Yeah, it's still. Yeah. So yeah, I posted something about the expectation. Already over the weekend we saw the Fed release some messaging that all this tightening may not be necessary, and already we're seeing that. We're seeing, what is it? I believe it was Evans. He, I think it was Evans. It was Evans that said that we may they may downshift one of the hikes for the end of the year. And again, this is the same exact narrative as the 70s. Same exact narrative. Just it does. It really does. It allows for inflation to come back, okay? And it doesn't come back like suddenly, and that's the problem, okay? It's just most people when they look for a problem, they want to see that problem like now, okay? But that's not how inflation works, and even if inflation comes back, it's not going to come back suddenly, like not in a month or two. It'll come back like 6 months or a year down the road when everybody thinks it's over. Okay, just like in the 70s, everybody thought that inflation was over. No, it wasn't over. They thought it was over in 76, 77. Nope. And then it was not until 79 that Volcker came in and really stomped it out. So they've been facing inflation in the 70s. They started in 69, 70, culminated, really crescendoed into 74, and then they went and they had a bull market year, and then it came back, and then that's why they lost a full decade. This is why inflationary periods can cause lost decades in asset prices. Yes, I agree. I think it would be better if they just raised it like 1% at a time, 3 times. Well, this was before that last rate hike, but before last rate hike, they just said we're gonna do 1%, and we're gonna make it all the way to 3.5, 4 by end of the year, and then we'll reassess for January. If the messaging was a little bit more like that, I think it would have been better. But and then they follow through with it too. But I don't think that's the case. I think they're going to, if history rhymes, and it often does. Maybe it won't this time. Maybe it won't. I don't know. But I think they're already messaging that they want to take the foot off the gas pedal. I think initially they will, because right now, yeah. Well, it may be a longer rally than that. Again, in the 70s, there was one rally that was like almost a year long in between a bear market. It's possible. It's in the realm of possibilities. I'm not saying it for sure. I have no idea. Nobody can tell the future. There's no crystal ball to this, and nobody knows. Nobody knows. Okay, but you have to be ready for that. You have to be ready for that possibility. And we're at Checkmate Trading. We're ready for that. I mean, I've been saying that for weeks. So hopefully you guys are ready for that. So trade accordingly, okay? So that's why I keep saying take your profits, okay? Protect your profits, protect your capital. That big move will come. You will want dry powder for that big move, okay? Keep your position small right now, all right? Look for other opportunities. Maybe not right now. We're in, that's why I'm staying away from U.S. equities right now. And I'm looking at other opportunities, EEM, China. I'm looking at, 5 or 6 moves ahead in some other asset classes. NEO wasn't. Oh, okay. Well, it pumped from 12 to 22. after it dropped from $66. I mean, yeah. Yeah. Huh. Well, I'm not really, I wouldn't get long on this. I mean, look at this. It's still losing money, man. I mean, okay, so again, what is the environment? What is the macro environment right now? Inflation is up, growth is low, and and interest rates are going up. Okay, you have a car company that's priced for future growth that's currently losing money. In this macro environment, should we be going long on something like this? Hell no, man. Hell no. Oh, buying puts? Okay, maybe that actually that I can go with. I can definitely. You know what, man? Let's take a look at the option chain for Neo, man. And it's a Chinese company too, so it may go down in sympathy with China if China goes down. So I can deal with that. Where is it listed in China? Do you know? Is it in the Hong Seng or is it in Shanghai? In Shanghai? Okay, so it's more with the large caps. Okay, interesting. I would think it was more Hong Seng, but okay, interesting. Which ooh. Current IV percentile is actually in the lower end. Oh, look at you! Look at you! Let's take a look. How much of them 15s? Hold on. How much of them 15s? So if you see the 2015 put spread for November is $1.72. Oh, but it's a little expensive. That's a little expensive. 2010. Hold on, 2010. Yeah, I mean it's still yeah. You know what, man? Yeah, I mean the some of the put spreads aren't bad. If you're gonna play Neo, and I'm not, I'm gonna I agree with Nunya here. I'm not gonna play this meme stock. I don't like sentiment driven stocks. I just tend to stay away from stuff like that. Um, if you're gonna play this puts, I highly recommend that you use put debit vertical spreads. The skew is pretty steep on puts, so the math gives you a little bit of an edge if you use vertical debits. Okay, you can actually take a little bit of that IV crush into your favor. Um, so if I were you, I would get into put vertical debits. So that would mean going long on a closer to at the money strike on a put, and then selling a further out the money put at the same expiration. Always buy the lower IV, sell the higher IV. And right now, because of the skew is definitely steep on that put side. I mean, that 2010, you're taking a difference of 81.89% and 105. I mean, that's huge. That's putting the math in your favor as far as IV skew is concerned. So if I were you and you're gonna do puts, I would do a put vertical spread. Don't do naked, okay? It's because if you do, I feel like if you get a rally, you're gonna take way too much of that IV crush. So again, number one job of a trader: protect your capital and risk management. Okay, don't think about the winnings first. Think about what your potential loss could be. Okay, always start from there. But that's how I would play it if I were inclined to be participating in Neo. I will not, though, be participating in Neo. That's just something I will not do. Okay. Anything else, guys? Anything else you guys want to look at? Man, this has been today has been a very interactive high noon highlights. Usually after about 45 minutes or so, everybody leaves, but we're in the hour 41-minute mark, and people are still here and interacting. That's good. That's good. That means people are looking for trades and stuff. Anything else you guys want to look at? Anything else you guys want to go over? You talk. Yeah, and you gotta be also careful with low dollar stocks. They're low dollar for a reason, usually. You don't have to. Okay, wait, hold on, Nunya. You don't have to buy shares to take advantage of selling premium. Why don't you sell call spreads? Why don't you sell call spreads on coin? You can sell call spreads and reduce your collateral if that's what you're worried about. No. No. You instead of selling just a naked call, because basically what a covered call is you're buying shares and you're selling a naked call against your shares. That's why it's not naked anymore, right? But instead of doing that, and because the reason why people sell covered calls is because they don't need additional collateral for to sell those calls because they have the shares. But if you don't have shares and you want to reduce your collateral on selling premium, you can sell like a call spreads, a call vertical. So we talk about buying vertical debit puts, right? Well, the opposite on the call side would be selling vertical credit spreads. Okay, so for example, let's say one day is you're not gonna get a lot of premium. Okay, so let's say you want to sell weekly premium on coin. Okay, so look at this. So let's say you want to sell some calls. Okay, let's take a look. I mean, it depends on what kind of delta you want, but like these, oh, I mean, do you really think by next week coin is going to be above, I don't know, 65? Let's see. Yeah, okay, but okay. Right now, so 65 for next week has a delta 19. Okay, it's a delta 19. For yeah, okay. So yeah, the 65-66 credit call spread, vertical spread. So you'd be selling the 65 and buying the 66. That's a $1 wide spread, credit spread. That means your collateral per spread is $100, right? $1 times 100, right? It's $100. Right now, you can get about 10 to 15 cents for every, so 10 to $15 for every $100 of collateral. So in 1 week's time, you could make 10-15% just by selling this one spread. Okay. So, I mean, you could still do it. You can still sell your, you can still make theta and still take advantage of IV crush and still not need all that collateral. Literally, for $100 of collateral, you can make 15%. Look at that on my screen, 15%, 15 cents for every 100 for 8 days. 15% in 8 days. What did I say? Remember how I told you all how you could be millionaires with $1,000? You take $1,000, you add $100 a week to it, you compound your money for at 2% a week, and in 5 years you're a millionaire. Okay? Do the math. Go get a financial calculator. Do the math. All right? $1,000, you add $100 a week from your paycheck to it, and you compound your money at 2% a week. You need 2% a week to become a millionaire in 5 years. I'm showing you how to make 10-15% in a week. I mean, you mean sell a strangle or buy a strangle? I mean, that's a very low probability trade, but I guess that is doable. I wouldn't do it. Because I just know generally those don't hit. I mean, you can do that. I mean, you could do that, but how many times out of each success, how many times you get burned because it goes against you? Probably, I would think half the times, right? Maybe about half. You're up overall, but I would say like your chances of it hitting or not is about half, right? It's like a coin toss. I mean, you can do that as long as you manage risk and you cut your losses early and you let your winners ride and you're always making more than you lose. A 50-50 bet is not a bad thing. Okay, you just have to have the right then take profit and stop loss strategy then in order to make that work. And if you're going to do that on something that's short dated like this, that means you're going to be in front of your monitor all the time. And even though I may be in front of my monitor all the time, I don't like to trade like that. That's just not my style. I like to look for big weekly, monthly moves. Okay, go with the trend, go with the data. Okay, because everything else is really emotional. And especially when you're doing it on a sentiment stock like coin, That's so sentiment. I mean, that's like Bitcoin. That's like as sentiment as it gets, man. That's just not my style. You know, I like to play the macro moves, and I like to look at the big trends. But if that's your cup of tea, that's your cup of tea. But all I'm saying is, if you want to take advantage of theta and IV crush and making premium off of coin, something like this, you don't have to own the shares to sell the covered calls. You can just sell call spreads, and your collateral is only the difference between the strikes. So even for $100, if you only had $100, you could try to make 15% by next week. It's possible. You know, you don't need. The point of all this was you don't need to buy the shares to take advantage of calls depreciating in value. You can use call spreads, and that's why I kept saying this, guys. You really have to understand options, Greeks, IV, all of this. And you know what? I get it. There's not a lot of good sources out there, and a lot of them either they get way too mathy, and you say screw this, and you hit the X, or it's not enough. Like there's no like source where it's just gives you just the right enough math and just right enough application of how to make money off of it. There's not a lot of good sources on that, probably because anything that's useful in making money, I'm sure people are going to want to keep that to themselves. But I'm working on a course right now on making a course on how to trade options and how to look at options. Even if you don't trade options, I think you should learn about options, because a lot of stocks today move because of the underlying options market. I should have that course soon by end of fall. I'll have a whole list of courses ready. And I'll open it up to everybody, and you can, watch it and learn from your leisure. I'll have different examples on there. I'll have examples of failures, how to manage those failures, how to roll, how to look at delta, gamma, what it really means. I'll even teach you some of the math terms so that you can hold up a conversation on your own. If somebody talks about Black-Scholes modeling, you can at least talk about it on a educated basis. So I'll have something like that. It won't be. It'll still have a little bit of math, because I think to understand options, you do have to understand some basic mathematics. But I promise it won't be too dry and it won't be too mathy. I will try to still make it as application based as possible. But look out for that. End of fall, I should have some courses out. So hopefully that should help you guys too. Any other questions? Questions, concerns, rude remarks? Okay. All right. We're here at the almost a 2-hour mark. I am going to leave our Twitch stream on. Okay. So you can take a look at the data and the charts that I'm looking at. And you can keep seeing what I'm looking at, and you can just follow along with me throughout the day. But as far as live talking right now, I'm going to log myself out, and then maybe I'll be back at the end of the day. Maybe in about an hour or so, I'll come back and we'll do a little like power hour or something at the end of the day. But this has been fun. I'm going to do a little bit more research on the uranium plays, and hopefully I can come up with a play in the next couple of sessions. Okay? Stay safe, and I'll see you guys soon.